All right. Hello, everyone. Welcome to ICW with Dr. Sherry Cooper. I'm your host, Eddy Cocciollo. Today's session is sponsored by FCT. And I'm smiling here, Sherry, because for the first time we got questions before we even begun our session. Usually I go through a introduction, but because of time, I want to get right into it. Today there was a blockbuster announcement, something that I didn't expect. I don't think you expected. Not many did. A supersized increase in the Bank of Canada. Mr. Macklem maybe heard you last month when you said, "Hey, pull the Band-Aid off, get right to the top of the range," and maybe that's what he's looking to do. I just want to add, Sherry. Usually we go through questions as you go through your presentation. Today, I really want you to go right through your presentation. So for those of you that have questions, you can go ahead and write them, but I won't be asking Sherry until the end of the presentation. I promise we'll get through all of them, at least within the hour. And if we have to go a little over, we may. We have a big audience today, lots of registrants. So I want to make sure that your questions are answered. Sherry's excited about them as well. Again, thank you, FCT, for sponsoring. For those of you that want to get in contact with one of our mortgage professionals, please visit dominionlending.ca. Also, you can click on Sherry's Economic Insights. And you know what? Here we go, Sherry. What are your thoughts? I know that you have your presentation ready to go here. This has been a shock for most of us on the 1% increase. What are your thoughts?
Yeah, absolutely. And this is just going to lead to more discussion about potential recession. And the discussion, the concern about a possible recession has certainly been in the minds of most market participants. We all saw that last week. The Royal Bank suggested that there would be a mild, moderate recession next year, and that it would be the direct result of the Bank of Canada taking the overnight policy rate to 3.5%. Well, today they took that policy rate to 2.5%. One fell swoop, of course, in that move, 100 basis points. It was widely expected in the marketplace that that number today would be 75 basis points. But let's get onto my slides. And what I'd like to do is start from the beginning and let's look at the background of where we stood as of first thing this morning when the Governing Council of the Bank of Canada made its decision. Now, Canada's commodity-rich economy has done extremely well in the recovery since the pandemic was at its peak and since the lockdowns ended. In fact, we've been the strongest economy in the G7. Now, because in large measure we do have such a large sector in the commodity space, and most particularly in energy, the rise in commodity prices that was so dramatic, particularly since the beginning of the Ukraine war in February, did boost exports, export growth, and the general level of the economy in Canada. When you compare our growth rate for 2022, which is around 3.7%, now reduced to about 3.5% since the bank's latest action, you see that it's much stronger than the 2.5% growth in the Euro area in the UK, even less growth than that in the US and Japan. However, growth is slowing in all those countries as well. So many are now predicting recession in the United States. The Bank of Canada today said that they thought US growth this year would be only 1.75%. And this shows you that as the year has progressed, we have seen a slowdown in the Canadian economy, and that's likely to continue. And this chart was drawn before the 100 basis point rate hike today. So growth is likely to slow, and we could see a real soft level of economic activity as we move into the latter part of this year. Now, the data have already been released for the monthly GDP figures for May, and Stats Canada told us that their flash estimate, which is a preliminary number, but still the flash estimate for GDP, did turn into negative territory in May as output slid in the oil and gas sector, in manufacturing, and in construction. And much of that slowdown could well have been a shortage in the labor market. We've seen that the labor market is just getting tighter and tighter, and the vacancy rate in jobs is getting higher and higher. In addition, though, we have seen indicators, leading indicators of a global economic slowdown. One important one is that base metals have more than given up their post-invasion into Ukraine gains. So seeing that develop is certainly a harbinger of a slowdown globally. In addition, consumer confidence in Canada has fallen sharply amid very strong inflation, higher interest rates, and the housing correction. So optimism on the consumer side has already been shaken even before the bank's actions today. Another leading indicator is just looking at the retail sector, and particularly the retail sector that's affected most by a housing slowdown. The high-end furniture retailer, now called RH, but better known as Restoration Hardware. This is they have slashed their forecast for the second time in less than a month, blaming the soaring mortgage rates and shrinking sales of luxury homes. Slowing housing market for the rest of 2022 is in their forecast. And I just thought it was interesting because Restoration Hardware sells into Canada as well, and it's very much consistent with what we are seeing in Canada in the residential real estate space. Activity has slowed significantly. Now let's look at Canada's jobs market. I was writing a piece regarding the Canadian job market. I was planning to anyway on Friday morning, just before the data were released. Of course, I went to my computer and discovered that I, like so many other Canadians, had absolutely no internet. So I was catching an airplane over that afternoon. There was a big family party in Baltimore, my hometown. And as I landed, I thought maybe I could write the piece then, but couldn't get into Stats Canada data. So anyway, here we are. I'm telling you now, as I'm sure you saw over the weekend, that even though the employment numbers declined a bit for the month of June, the employment level is well above the level we had posted in early 2020 before the pandemic began, and even more shocking really, is the continued decline in the unemployment rate. That jobless rate hit another new record low, falling now to 4.9%. It was at 5.1% 1 month ago. And you see that that is well below the level that we've experienced right before the pandemic began, which was already considered full employment at 5.7%. In addition, we've seen that job vacancies continue to grow. They have reached a record high in Alberta and Ontario. And as well, we saw that average hourly wages accelerated again. Now, in the month of June, year over year, they've risen 5.2%, which certainly spooks the Bank of Canada, because this is part of what they're concerned about in regards to inflation becoming embedded. If we get wage price spiraling, then inflation becomes far more embedded into the economy. And so the Bank of Canada, no doubt, took great notice of these data. In addition, Ottawa continues to expand the temporary foreign workers program to help reduce labor shortages. And they've already increased their immigration targets for this year and next year. But nevertheless, the excess demand in our economy is huge, and it's unlikely to dissipate in short order, largely as a result of interest rates having been so low for so long. There's clearly been a policy error, and it's not a Canadian phenomenon. It's happening all over the world. But central banks all over the world, I believe it's safe to say, were too aggressive in easing policy as the pandemic took hold, and took far too long to begin to renormalize policy as the lockdowns ended. So as a result, now they're slamming on the brakes rather than tapping the brakes. In addition, we're seeing that the wage inflation is likely to accelerate further. Average offered hourly wages, especially in the hotel and restaurant industry, have surged in recent months, and there's no end in sight as of now. So inflation is the key issue here. And the Bank of Canada wants to reiterate many, many times, they've said this, that they are committed to taking inflation back to the target of 2%. They've been wrong on the inflation outlook. And in fact, in today's monetary policy report, they have a multi-page appendix that tries to show why they were so wrong in their inflation forecasts, and blaming it largely on the unexpectedly strong rebound in the Canadian economy, as well as global factors that accelerated the commodity prices and the supply chain disruptions, the movement from globalization to deglobalization, and the huge costs increases in terms of costs of production, costs of construction, and therefore the pass off of higher prices to the consumer sector. So inflation remains the big story. Now, in May, the latest data available for Canada, the inflation rate accelerated to a whopping 7.7%. The June data for Canada will be out next week, and the Bank of Canada today suggested that it would be over 8%. For May in the United States, inflation was 8.6%. Well, as of this morning, they released the June CPI inflation numbers in the US, and it's now at 9.1% on the back of higher gasoline prices, shelter, and food costs. So clearly, and you can see this on the chart, inflation is moving straight up. This is an asymptotic increase in inflation. We've seen nothing like this since 1981, before Volcker was successfully broke the back of inflation with just rocketing interest rates, sky high levels. But the question then remains, well, how hard will it be for central banks around the world to break the back of this inflation? And given that we have no real historical precedent for it, the bets are off. And not only that, but according to the latest surveys by the Bank of Canada, businesses are now expecting inflation to remain high for 2 years. So that was another factor mentioned today in the bank's press release and in the bank's monetary policy report, that they had to step up their tightening, accelerate the rise in interest rates, because if they didn't, it would take higher interest rates, they said, in the future to get inflation back to the 2% target, which they are committed to doing. Now, with inflation expectations rising and wages accelerating, the home price slowdown is really the most important development recently, because it is a leading indicator of inflation pressure. And so the most interest-sensitive sector of the economy has always been the real estate sector, and the consumer on the residential real estate side is the transmission mechanism of monetary policy. It is through this mechanism that the Bank of Canada and other central banks tighten monetary policy with higher interest rates, the most interest-sensitive sector being housing, and therefore begin the slowing process for the economy and ultimately for inflation. So monetary policy certainly did get our attention this morning. The announcement of a full percentage point rate hike today, it was startling, really, mostly because though the bank did tell us on June 1st, when they met last time, that they could accelerate the pace of tightening, we took that to mean going from 50 basis points to 75 basis point rate hike. And we were certainly not the only ones. That was the general market expectation. It was embedded already in the financial markets. The bank also continues its quantitative tightening, letting the balance of their holdings of Government of Canada bonds run off gradually as bonds mature. But prior to the announcement this morning, the traders were betting that the overnight policy rate would be at 3.5% by the end of this year. Now, I have to believe that markets are still expecting at least a 3.5% policy rate by then. And it could well be at that level sooner than year end. So here's another thing to look at. I think it's really interesting that more than 30 central banks have taken similar action to what the Bank of Canada did today already in 2022. Those countries are highlighted in red, Canada, of course, being the most recent central bank to raise rates by a full percentage point in one fell swoop. But if you look around more closely at the countries that have done this, there are not major industrialized countries. We're the first to do this. And, you got to believe that this is something that this aggressive action is very much reflective of the Bank of Canada's fear of losing credibility as an inflation fighter. Remember, the Bank of Canada has a single mandate, which is to target inflation at 2%. The Federal Reserve in Washington has a dual mandate, which is to stable prices, but also full employment. So we are clearly in very tight labor market situations. I agree with the bank's assessment that we have excess demand. And so the Bank of Canada seems to be willing to see the risk of recession rather than the risk of accelerating inflation. So now the Bank of Canada's overnight rate is at 2.5%. And you can see, by the way, that we had an aggressive easing in monetary policy very fast as the pandemic began in early 2020. And now we've moved the policy target to well above the level prior to that full employment, low inflation level at the beginning of pandemic. So the policy rate at that time was at 1.75%. Now we're well in excess of that. There's another fundamental here that's very important to note, and that is the bank's estimate of the neutral policy rate. Now, that's defined as the policy rate that neither causes accelerating economic growth or decelerating economic growth. And the bank estimates that in a very broad range to be 2% to 3%, somewhere in there. The breadth of that range is very much reflection of the uncertainty of all of this, because no one really knows what rate it will take to slow economic activity sufficiently to begin to see the inflation numbers roll over. But right now, what we've got is the policy rate is right dead in the center of that neutral band. And Tiff Macklin told us today that he believes interest rates need to rise further, at least to the top of that band, which would be another 50 basis points, or he said, and I'm quoting, slightly above that target level. Well, embedded in the marketplace is another 50 basis point rate hike when they meet the next time, and then 50 and then 25, which would take that to 3.75% right now. So hold on to your hats, I guess, is my message. Also, the prime rate, which is currently at 3.7%, no doubt the banks are already starting to hike prime, but will move in rapid fashion to 4.7%. And of course, that impacts then the offered rate for variable and adjustable rate loans. And we're headed for a prime rate of, call it 5.2 to 5.7% by year end. The bank in today's monetary policy report, this is the July report, once a quarter, they release their full forecast for the Canadian and global economies. They showed this chart in their monetary policy report, and it shows borrowing rates for households and businesses have already risen sharply. And they've got their 5-year variable mortgage rate and the 5-year fixed mortgage rate that they publish weekly on this chart as of last week. So these data are slightly lagged, but not much. And you see interest rates have already increased very sharply and have already had quite a negative impact on housing. The 5-year bond yield spiked this morning as of when I did this snap of the market, which was probably about an hour and a half ago. The rate was at 3.16%, but you can see that it'll be very volatile over the next day or two. And then we wait to see what the market implications are in terms of the forecast for recession versus just a slowdown in housing as opposed to a full-blown recession. So, of course, the bank is hoping for a soft landing. I mean, yeah, of course. I mean, they would love to have their cake and eat it too. They would love to see what they used to call transitory inflation. That inflation magically comes back to 2%, which they're not forecasting, by the way, until 2024. So they've really upped their forecast for inflation. But unfortunately, whether or not they get that wish without a recession is very uncertain. So a slowdown doesn't have to mean a recession, but given historical precedent, I'd have to expect that we will see a significant slowdown in economic activity. And, could that mean a recession in 2023? Certainly it's possible. Right now the forecasts are suggesting there's a 50-50 chance. And honestly, no one knows for certain. Now, to the Canadian housing market. We won't see all of the Canadian Real Estate Association data for the housing market until Friday, and I will certainly publish a report on that on Friday morning. But so far, let's look at what we do know from the regional surveys. Toronto home sales plunged in June, down 41% year over year. Very, very dramatic slowdown. Listings surged and average prices have fallen. Now, Toronto was ground zero for much of the surge in home prices, so it's not surprising that we're seeing a very rapid response in the Toronto marketplace as buyers have moved to the sidelines in the hope that prices will fall, that demand will slow, that new listings will continue to rise, and therefore much higher inventories. We have seen the market shift to a buyer's market. But until there's evidence that prices have fallen as far as they're likely to, many buyers will certainly remain on the sidelines. Now let's look at the regional surveys in other parts of the country. In Vancouver, home sales were down 35%. The resales numbers, new listings continued to decline, but not by nearly as much as what we'd seen earlier in the cycle. In the Fraser Valley in BC, even more aggressive slowdown, 43% decline in resales and a 7.2% increase in new listings. In Calgary and Edmonton, the housing markets remain much more robust. They've slowed a bit. The home sales resales data have declined, but only slightly. And that's because the oil and gas sector, though it has slowed a bit, is certainly much stronger and leading to much stronger economic activity in that region where there continue to be mounting labor shortages. You saw the numbers for Toronto already. In Montreal, we see a more modest decline in resale activity, down 11%, with new listings surging 23%. So clearly there's a widespread slowing in residential real estate. This looks at the demand supply conditions, the sales to new listings ratio. And you can see that rising inventory and falling demand has returned most of the major markets in Canada to a balanced market position. And arguably the Toronto market, at least in some parts of that market, is already in a buyer's market position. So these are very dramatic declines in the sales to new listings ratio. For example, late last year in 2021, in December, the sales to new listings ratio in the GTA was at 100 points. So that's incredible. And now it's slowed to 45 basis points. So this is all very important in terms of the reaction to the most interest sensitive sector in the economy. Now, let me just comment that what the Bank of Canada said in today's report is that the slowdown in housing activity has occurred from unsustainable levels of strength. So, in other words, they're not lamenting the slowdown in housing by any means. They believed it was excessive, it was unsustainable. It was a direct result of the change in preferences arising from the pandemic, and that it is a good thing, a cleansing development to be slowing housing the way they are right now. So these are the aggregate national data for the latest available data, which is May, and you can see that home resale activity had already slowed since March. We've seen that the sales to new listings ratio had already fallen, that the aggregate MLS home price index has fallen in price. Certainly this is, again, nationally, but it's falling in many different parts of the country. And here I just show you the 3-month change as of the May data for different parts of the country. So you can see there's a spot in BC that's down 5.4%. In Toronto, it's Greater Toronto, it's down 2.5% as of May, but it's much bigger declines in some of the suburbs or hinterlands of the GTA because of the huge run up in prices during the pandemic period. So very aggressive declines in prices already in suburban GTA or even the Greater Golden Horseshoe. And finally, there's all sorts of dislocations happening as a result of this activity and the rapid turnaround in the housing sector. So falling home prices, just an example, have caused appraisal gaps in some regions so that borrowers who were to have an 80% loan to value ratio, when that value declines, some are forced to come up with more cash. and that's causing dislocations. We've also seen that higher interest rates remove some buyers from the housing market and certainly reduce the purchasing power of others, and particularly so given that the qualifying rate for mortgages is now much, much higher if you don't have a variable rate loan. And it's keeping some buyers in the variable rate loan market, even if they might decide that maybe they should consider locking in at some point. So we've also seen a significant impact on investors that are moving to the sidelines because mortgage payments and property taxes are rising much faster than rents in many of the hot markets. So, and this is also a welcome development as far as the Bank of Canada or the government of Canada is concerned. Remember, in the last budget, they tried to constrain activity in the investor sector. And we could also see some distressed listings in the coming period, especially for recent investors with short-term financing, and Metro Toronto is already a buyer's market. And by the way, I just noticed I have a repeat here. CC, you can tell I was trying to change all this at the last minute here, so sorry about that. Finally, on the supply side, I had already thought that doubling home construction over the next decade was not going to happen. And I certainly think that all of the rise in interest rates and these developments make that further a less likely possibility. I mean, already in 2021, home building was at a 46-year high. And Canada may want to double home construction, but needs to find skilled workers. And there's a shortage, major shortage in the construction sector. In addition, the data have already told us that residential construction costs are rising rapidly and have risen rapidly over the past year. And so that really is causing difficulty in home development. And we've now seen indications from housing developers that they expect to cancel some projects because of both the construction costs soaring, both because of worker shortages and material shortages, and a big increase in the price of so many of the inputs in the construction process for homes, and as well interest rates rising. So loans become more expensive. Pre-construction buyers, many are sidelined, and to the extent that home prices continue to fall, we may well see projects canceled because they no longer make economic sense for developers. So if anything, we're going to see that the housing supply will slow in the next year or so, as opposed to the big increases that we so desperately need. And then finally, the Bank of Canada sees a sizable pullback in housing activity over the next year. That's direct wording taken from the Monetary Policy Report released today. They see home resales and prices decline over the next year. And by year, I mean that literally, like through the middle of next year. They see residential construction and renovations dropping through the middle of next year. And then finally, in the latter part of next year, activity will stabilize as both population and income growth boost housing demand. but they do not see growth in housing activity resuming until 2024. And it's by the end of 2024 that the bank sees the housing market can resume its growth. So I got to tell you, Eddy, this is not good news for the outlook for housing, but we wish the Bank of Canada all the success in the world in getting inflation down as soon as possible.
Thanks, Sherry. And we have a lot of questions. Before we get to the questions, I just need to understand where the Bank of Canada and policymakers, bankers right across the world, if they know that this increase in interest rates are not really going to help inflation, not in the short term, not that we're seeing it so far. Like, they've obviously increased rates and inflation is either the same or higher than the month before. So it's not working necessarily. So when do they stop? Do they not stop until inflation is in that band? Do they get regroup and say, okay, you know what, this is not working. We got to come up with another plan. In your opinion, what is it that they're going to do if they feel like rising interest rates are not impacting or tampering the inflation rise?
Well, you see, Eddy, they're not going to expect inflation to come down immediately. They're expecting the economy to slow fairly quickly, and they're already seeing that. So in their view, they've been successful, and that it's only a matter of time before the slowdown in the economy starts to show through in inflation. But inflation is coming, and they make big points about this, that inflation is coming largely because of global economic factors, the disruptions associated with the pandemic first to the supply chain, and then ultimately the Ukraine war. And the Ukraine war is still going on. And not only that, but, though oil prices have come down in recent weeks, there's great risk that oil demand is going to increase, particularly oil and natural gas, as the weather firstly heats up, and we've seen very significant hot spots around the world. But then secondly, during the winter, when all of Europe depends on Russian natural gas for heating. So, and even if the war by then is at a stalemate, there's no way that the sanctions will be ending. So the energy sources from Russia will not be flowing into Europe. So it's a big problem, far bigger than what's under control of the Bank of Canada. Now, the Bank of Canada was asked repeatedly today. Remember, they have two press conferences. The one press conference is for the media, and that's where Tiff Macklem speaks along with his deputy. And he was asked directly, like, what will trigger the next cut in interest rates? And basically, and similarly, there's an Economist press conference that occurred this afternoon, and I heard the same question asked there, economists at the Bank of Canada. And both of the answers were, it depends. And it means it depends on economic activity. It depends on the incoming data. And no one is going to tell you at the Bank of Canada with any precision what in fact is going to happen, because they have been awful in their forecasting ability, really awful, and not any worse, by the way, than most other central banks, but still, they don't know. And therefore, we could see policy errors. The biggest policy error could be that they end up hiking too fast and causing major disruption. I think the big policy error they've already made is firstly taking interest rates down to historically almost zero, very low levels, which only led to the expansion in the housing markets. And then secondly, waiting too long to renormalize monetary policy. And, initially they said that inflation was transitory, and then laterally they said that, we'll begin to see inflation peaking and it'll happen at some point, and no worry here. And of course, now it looks like all the central banks around the world are going to take the lead from the Bank of Canada and continue to aggressively hike interest rates and just basically see what happens.
Yeah. So your prediction of the 50, 25 to 375, I mean, it can go up or down. It all depends on, how TIF is feeling and how the economy is going and how inflation is. So it is hard to predict.
It is. And I mean, I was at the Fed, dating myself. I was at the Fed when Volcker did hike interest rates to the moon. And he had to take rates to much higher levels than he'd ever expected in order to break the back of inflation. Now, there's been just reams of ink spilled in recent weeks regarding how the current inflation story is nowhere near as entrenched or embedded as the 1980s inflation. But nevertheless, it's no one knows really what it will take. And the markets themselves will invert the yield curve at some point. In other words, the central banks can increase short-term interest rates, but at some point, if the markets are perceiving recession, longer-term interest rates are going to fall.
Okay.
And that could be the time when everybody wants to lock in, actually.
Yeah. Okay. So we have quite a few questions. So, there's going to be questions that overlap. I'm going to try my best to go through and not repeat previous questions. So the first question I'm going to ask is from Lily. In your opinion, how likely the lenders will extend the amortization period for borrowers? So you're hearing about some aid or some help from the government and help them with their payments. Do you think that's likely?
No. I don't. And I think OSFI is certainly going to put the kibosh on that if it starts to become widespread. Now, OSFI only controls the federally regulated institutions. But remember, the Bank of Canada, these are the same people that put out their financial risks publication, which was just released about a month or so ago. And they constantly are looking at the proportion of home buyers that have very high debt levels. And so the last thing they want is to encourage people to take on ever higher debt levels.
Yeah, that makes sense. So we haven't seen much foreclosures in a while. Alex asked, do you think foreclosure rates and stress sales, specifically in BC, will happen? What are your thoughts there?
Not in a big way. I don't. In fact, I was interested to read about some of the mortgage investment corps and what they've decided in terms of basically trying to be more prudent. And even in their world, the delinquency rates are extremely low. And Canadians will continue to do everything they can to make their mortgage payments. And there's a relatively small proportion of Canadian homeowners with mortgages that are at risk of becoming, going into default. I mean, it's a very small percentage of the population.
Yeah. And the correlation is employment more than anything when it comes to defaults and employment. You saw it. We're well beyond, the rate of employment. We're 4.9%, which is pretty incredible. So yeah, it's going to be tough to see people miss payments when they're working. They're making more money than they ever made. Why would they miss a mortgage payment? So that makes sense. Elephant in the room about inflation. Rob asks, what is, which is, of course, government spending, printing money. So the printing of money definitely contributed to this inflation. Would you agree?
Yes, of course. That's the way they reduced interest rates during the pandemic. And we all saw that, when the pandemic began, most people would have worried that housing would take a hit. And that seemed to be the general consensus in the early days of pandemic, but we had no idea that the Bank of Canada would lower interest rates to the degree that they did, and that mortgage rates would fall to historically record low levels. That's why I say that was a policy mistake. And so, as a direct result of that, it helped to cushion the blow to the economy of the pandemic. But as you can see, that may not have been the right thing to have done.
You heard the word stagnation or stagflation a few times. I know I've heard it. Bernie asked, do we have the ingredients forming for stagflation if wage inflation gets cooked into the economy?
Yes, and that's what is happening in parts of the world. Certainly in the United States, there's been a slowdown in economic activity, and also very high inflation continues. But that's a transition period. I think that ultimately you do get the reaction of lower inflation, but it usually takes a rise in unemployment rates to get it. And as we keep saying, the unemployment rate keeps falling. So until the rise in rates bites hard on the job side, we may well continue to see economic slowdown with continued inflation.
Makes sense. Question around the Bank of Canada rate. So how does the Bank of Canada determine the neutral rate range? How is that determined?
They guesstimate, which means they use econometric analysis, which uses history to predict the future. And given that we are in unprecedented territory, like once in a century pandemic, and also a Ukraine war that is having global effect, you can believe that there's a tremendous error range in that neutral forecast. So we don't know what truly the neutral rate is. We just know it's probably higher than it used to be. And that's why they're pushing the limits of the range to see basically how much is it going to take to slow the economy sufficiently, which has got to mean higher unemployment rates to get inflation down to 2%.
So we have about 6 minutes left here. Just want to say thank you to FCT for sponsoring today. Sherry, you're always so insightful. The way you deliver your presentations is much appreciated. A couple more questions. One I wanted to ask was around the variable rate versus the fixed rate you talked about. And before the call, you like to know your payments, so you go fixed. There's variable rate clients right now that are wondering should they fix their variable rates. You talked about the neutral rate continue to rise. What would your advice be for people that may have a variable rate today or are purchasing or refinancing, and what they may choose between fixed and variable? Do you have any advice?
Well, again, there's no one size fits all because everyone has a different set of circumstances.
Right.
But if you're expecting to be in your home for more than 5 years, and if you feel that you've got good levels of job security, and you're able to have a cushion in terms of your future, like unexpected expenditures, you've got some precautionary savings, then maybe you don't need to worry so much about whether market rates go up or down. But honestly, I personally, if interest rates, even today, fixed interest rates are low by historical standards, and I just like the certainty of knowing what my monthly payment would be.
Yeah, and the truth is, like you said, there's circumstances for everyone, and that's why advice is important. To talk to a mortgage professional to ensure that whatever your situation is, they can give you options. There is strategy in mortgages, so please reach out to one of our mortgage professionals. You can reach out to them via our website, www.dominionlending.ca. They can help you with your strategies. They can understand the situation you're getting into and help you make the best decision, most informed, educated decision on if you should go variable, if you should go fixed, if you should take your variable into fixed. They can definitely help you with that. Couple more questions really quickly. If a recession hits, how will this morning? There was a deep downturn in the markets. It recovered mostly. I'm not sure where it is because I've been on the call with you, but as we head into a recession, what's going to happen with the markets, in your opinion?
Well, I mean, I guess you're talking about the stock markets.
Yes.
Yeah, the stock markets are in, I mean, they've had a terrible 2022, and that's certainly not over yet. And, economic slowdown, all this uncertainty, the massive run up in the stock markets over the pandemic period, all of those things are very similar to the housing markets, and were the direct result of interest rate cuts that were far bigger than they probably should have been. Mm-hmm. And so no wonder everybody piled into all of these assets that actually, are interest sensitive. And now the question becomes, how much higher do rates have to go? And therefore, how long will it take till things do re-normalize? And it's going to be a while. And I think that basically that's what the Bank of Canada is telling us, that they don't expect 2023 to be a good year either. And in fact, will we see inflation back to 2% by the end of 2024? I don't know, but if we do, I'll have to bet it's because we've seen a substantial slowdown in economic activity.
Yeah, absolutely. I mean, the government, just as quickly as they are trying to tamper inflation and using interest rates to rise, once it gets to that target rate of 2%, they'll definitely go the other way, obviously depending on where the economy is. So thank you, Sherry, for your time today. Thanks everyone for listening. We appreciate it. Until next month, actually, the next one is going to be in September. 6 weeks, about 6 weeks. No.
There's one in between. There's one before then. There's one more.
I should have done my homework before.
Yeah, I just didn't. It's in my calendar, but I can't remember.
Yeah, we'll have plenty of marketing out there so that you don't miss it. Thanks everyone for joining us today. Thank you, FCT. Have a great day. Bye-bye.